Well, let's welcome in Saion Mukherjee. He's the head of equity research at Nomura, India, joining us right now on the show. Saion, good morning to you. Speaking to you after long. Let's talk about all that's happened in between. We got the budget, we got the RBI policy, we got a trade truce, and then we got coronavirus. Lot of things to digest for the markets. But what's the call from Nomura?
Yeah, I mean, at an index level, we are forecasting around 7% upside from the current level by the end of the year. I think we are forecasting some sort of recovery, a cyclical recovery. So if you look at our portfolio, it's positioned towards that recovery. So yeah, I mean, in the near term, we do see slowdown continuing. Our economics team actually is forecasting that for the December quarter, we may see a growth print which is probably even lower than what we saw the previous quarter. But then we do expect recovery going forward. So that's how our portfolio is largely positioned.
Saion, are there any changes in the weightages or the propellers of growth in terms of industries that you see for the markets, where some additional funds can come in from the FII desk, where there is interest on the back of the fact that there could be a turnaround for those spaces?
Yeah. So, if you see what we have been kind of expecting is a recovery driven by the kind of monetary policy stimulus that we have seen, right? If you look at the entire last 1 year, we have seen 135 basis point cut by the Reserve Bank. We have seen ample liquidity in the system. I mean, proactively, the Reserve Bank has been adding liquidity. It is also supported by foreign flows. And then lately we have seen actions by the RBI with an effort to improve transmission of those rate cuts. So historically, if you see, right, we see a reasonably strong correlation, a lagged correlation between liquidity and industrial growth. As we see things today, there's a complete divergence. You have ample liquidity, but growth is still struggling. So our view is that as we see this transmission happening, we would see gradual recovery taking place. In terms of the sectors that would see, I think it could be across board. To start with, we may see improved traction in consumer discretionary. But over a medium term, given the policy push, I think it would be largely investment-led. So you have construction, infrastructure, capital goods. These are the segments from a medium-term perspective, like 1 to 2 years is where we see a revival in growth.
Saion, are you, encouraged by the retail participant in the equity market right now? We've been seeing the mutual fund data coming out. There has been a pickup, and the SIP numbers on a month-on-month basis has been going strong. So the retail investor still is fully entrenched in the market.
Absolutely. So I think there has been a change, right? So we have seen, of course, the broader market has seen a lot of issues, but at the index level, the returns have been okay. It's not been a disaster, right? And I think there is a fundamental shift in retail participation as you see these sticky numbers. So I think this added to the foreign liquidity, I think augurs well for the market in general. And, from a liquidity standpoint, we remain constructive for this calendar year.
Do you think it's going to be liquidity that's going to drive much of the gains for the rest of the year for our markets as well? Because fundamentals are not changing all that much, even in terms of the kind of earnings performances that we're seeing, barring a few handful of companies which are managing to, surprise positively. So do you see, prices coming off or the fact that, people are ready to pay any price right now because of the lack of investment avenues?
Yeah, you're right. So I think earnings have been quite disappointing. I mean, in fact, I would say towards the later half of last calendar year, the intensity of earnings cut increased. as the slowdown progressed. What we are expecting is that given the fact the expectations in many pockets are quite low, and as you see cyclical recovery take shape, we would expect earnings to come through. So I think at this point in time, the market's confidence on earnings is low. That's why you see we still have a pocket of stocks where the earnings visibility is relatively high. There is no major capital allocation or governance issues. The multiples are just moving higher and higher. That, in our view, is likely to change, right? As you see a recovery or get some confidence on growth, and you find earnings visibility high, what we expect is that it would be a broad-based rally where we would expect some of the underperformers, to start performing.
Saion, good morning. Neeraj here. Do any of your large global clients are they getting interested in some of the lesser represented pockets? I mean, asset management companies, back-end manufacturers, specialty chemicals, all of these have now become true blue sectors in the Indian markets, even though the quantum of companies and the liquidity might be in question at times. But are global clients showing interest into any of these smaller pockets?
Yeah, I think, I would say in general, the universe or the number of stocks, let's say the global clients have been looking at has reduced quite a lot. Because, the fact is there are a lot of concerns on the economy, on the macro and earnings visibility. So I think, there are select stocks and select pockets which is getting a lot of interest. And some of the sectors and names that you mentioned, I do see incrementally more interest there. But in general, I would say it's not a very broad-based interest at this point in time.
Okay. One pocket, because you would be looking at some of these companies on a global platform as well, things related to capital markets. Now, two or three things. There's a bit of a revival in sentiment at the broader end of the spectrum. Also, January saw some substantial equity-linked flows, which people believe could become a trend as well. What about asset managers? What about brokerage names or things related to capital markets? I mean, there are individual names like CDSL, etc. also. So it's a large bucket. What are your thoughts here?
Yeah, I mean, see, if you look at our portfolio, we do not have, in our model portfolio, any of these, segments or names that you mentioned, primarily because, a lot of this has run up quite a lot, right? And, today, I mean, I understand, some of them have structural stories related to inflows. But given where these valuations have moved up, and some of them are also linked to market performances, so we find at this point the risk reward not very favorable. So in our portfolio we are avoiding such names at this point.
Saion, what's your take on healthcare? In totality, be it the pharma end of it, be it the diagnostic end of it, be it the hospital's business, everything coming together. Is this a turn of the page for the healthcare space? Because we've seen a lot of interest that's coming into specific pockets, and just the fact that up until now it was not so activated, and suddenly there are green spots all over the place.
Yeah, if you look at the performance in the healthcare space also, it is very much similar to what the general trend is, right? It all comes down to earnings visibility. So if you look at within healthcare, you have diagnostic names which have done very well. You also have pharma companies who are exposed more to the India business, right? Where there is an element of secularity, there is greater visibility, you see the multiples moving higher. At the same time, if you have the the traditional US generics businesses, you haven't seen a great performance there. So ultimately, I think it comes down to visibility of earnings, and which is obviously higher in pockets like diagnostics, hospitals, and India specific pharma companies. So we see that stocks getting re-rated. From our portfolio perspective, actually, we have both US-centric as well as some of these healthcare names which are focused on India, particularly because even after the run-up, if you look at the valuation multiples for some of these names, which are like trading at less than 20 times, FY22 PE, would be growing at 15-20%, do not have debt on books, no major governance issues, and if you compare it with some of the other sectors, like for instance in the consumption space, there's still a huge valuation gap. So on a relative basis, pharma valuations are attractive, even after the run-up that you have seen in some of these pockets. As far as US linked or US generic exposed companies are concerned, frankly, it's difficult to time them, but I see a good value in those stocks, and therefore we think if we wait out for a year, we should see some traction at some point this calendar year.
Saion, it seems like consumption names, even though we've been talking this entire year, has the undertone has been that consumption is not picking up at the pace it should be. There has been a lack of spending on consumption. Discretionary spends have gone on. But aside from cars and aside from the auto space, almost all of the other names are still trading at heady valuations, and there are still pockets of interest where you've got brokerages coming out and saying that this is not the end of the move, and even if it's this expensive, it probably will get more expensive.
Yeah, I mean, that's been difficult, because I guess obviously the numbers for some of those consumption names have been actually quite okay. Also the fact that going forward, I think there are some green shoots. As I mentioned, like in the discretionary space, we think as the overall broader economy stabilizes and revives, we should see stronger growth there. Even areas like rural, right, which has been quite disappointing in 2019. I think in this year we may see a greater traction. The terms of trade are improving. You see higher prices for agricultural produce, and the cost of inputs have come down, so that's positive for them. So the sowing season looks to be going great. So I think at the margin there are expectations that rural will also start to pick up. So in that context, I think people see stronger earnings visibility. But the question remains how much we want to pay for that, as we are sloshed with liquidity, and that is chasing a handful of stocks where you have earnings visibility, and these multiples keep going higher. So it's very difficult, and fundamentally we find difficult recommending a buy on some of these richly valued names. Though we agree that in the recent past we have been wrong, and these stocks have kept going higher.
Okay. Saion, pleasure chatting with you. It's been long, but look forward to have you more often on our forum. Thanks so much for speaking to us today.